If you've got extra cash flow every month, no high interest debt, and a strong emergency cash cushion, you are probably ready to start building your wealth a little bit more proactively. But where should you start? What's our ideal order of operations here in the US from a tax standpoint if we're concerned with building long-term wealth for financial freedom? Let's talk investment priorities. Why does this matter? Well, short of generating an outrageous amount of passive income from being a business owner, there's really no way around investing in something if you ever want to retire. But investing is just about the world's broadest term, and believe it or not, there are a lot of ways to approach it incorrectly, and most of them are probably beyond the reasons you're thinking of right now. Most people are not investing $10,000 in a single stock and crossing their fingers, so it feels silly to waste a bunch of time advising against taking some outsized risk to try to beat the market with picking individual stocks. Instead, let's back up a step. Let's pretend we are looking at a few different Easter baskets full of eggs. Now, each egg represents an index fund or a stock. We're no longer looking at which eggs specifically to pick. Okay, we're looking at the baskets in which you can put those eggs because all baskets are not created equal. Some have bigger holes in the bottom than others. Some have a higher cost of entry for each egg. So what's basket number one? Your 401k. If you have access to a 401k, 403b, 457, any of those through your employer, congratulations. You have a basket with a $20,500 limit in 2022, of which the IRS won't tax the contribution in your current tax year if you opt for the traditional plan, and it'll defer taxes on the growth along the way. This limit is set to rise to $22,500 in 2023, so get pumped. Ultimately, the reason everyone urges you to use your 401k, aside from the possibility of an employer match, is not just because they want you to save for retirement, but because of taxes. Now, I used to wonder why everyone was so riled up about 401k plans and their equivalents in the public sector. Can't I just save for retirement in a different account, I would think? And yes, there are other options, but the 401k is special because it's a way for you to invest a sizable amount of money for the long run and defer income taxes on a big chunk of your income. This is usually the point at which someone asks, but Katie, my 401k plan can be Roth too. Should I use Roth? Now, make no mistake, I am a fan of tax diversification. I think everyone should have a little bit of everything for flexibility later, but it is the official opinion, until otherwise stated, of the Money with Katie show that if you are in the 22% marginal tax bracket or above, you will be better served in the long run by contributing the maximum to a traditional 401k. We'll link a blog post in the show notes that explains the logic behind that sentiment further, but for now, here's why. It comes down to three major arguments for me. Number one, an upfront tax break creates more investable income. Because a traditional or pre-tax contribution is effectively deferring that salary into the future, it directly lowers your tax bill in the current year. If you imagine a $100,000 salary, to use nice round numbers, that's taken fully as income in the current year. Whether making no 401k contributions at all or contributing to a Roth 401k, it's all treated as income in your current tax year. A chunk of that salary has to be sent to the IRS to pay your taxes on the salary. In this example, the total federal and FICA tax bill is about $22,000. If you instead invested $20,500 of that salary in your traditional 401k, that is effectively deferring $20,500 of it into the future, it's like you're lowering your salary by that amount, despite the fact that you are still keeping it as part of your net worth. Your tax bill now is only about $18,000, meaning you spend net less of your income on taxes and keep net more. That $4,000 or so difference will stay in your pocket, effectively showing up on each paycheck or returning to you in the form of a tax refund. So that $4,000 is investable income that you literally did not have before. TLDR, a traditional 401k simply allows you to invest more. Now, this is normally where someone says, well, you have to pay taxes on that money eventually, so isn't it a wash? Which brings me to reason number two. The way our tax code is written today, There are technically ways to get your pre-tax funds back out of your 401k tax-free. This process is known as a Roth IRA conversion ladder. We covered it in episode 36, how to pay no taxes in early retirement. It leverages the standard deduction really strategically. But the gist is that the traditional 401k provides more flexibility for controlling the tax rate that you pay on your income now and later. Now, this is usually the part where someone says, but Katie, what if I have a higher tax rate in retirement? Won't I have a higher tax rate later? That brings me to reason number 3. It is almost impossible that you will have a higher tax rate in retirement than you do as a working professional, especially if you're beyond your first few lower income years of your career and don't have plans to own cash flowing businesses to fund your lifestyle in retirement. That's a different story if that's the case. But I find that this concern typically stems from a fundamental misunderstanding of how you're taxed in retirement. Technically, your only income comes in the form of withdrawals from your own retirement and brokerage accounts. And after a certain point, Social Security, which TBD if that will actually be around for us in 40 years from now. Theoretically, you won't be withdrawing more than you need to spend because there would be no point to take the money out and claim it as income otherwise. Of course, if you work for a really, really long time, you make a lot of money, it is possible that your Social Security payouts will be decent, but that's pretty hard to project from our vantage points now, 40 years away. The point is, you'll only be taxed more in retirement if you are spending more than you're earning now. The paradox is this. If you're in a lower tax bracket now, the only way for you to be in a higher tax bracket in retirement is by spending a ton of money after you retire. But you won't have a ton of money to spend every year in retirement unless you are earning and investing a lot now. And if you're earning and investing a lot now, you are likely already in a tax bracket that you will have a hard time outspending later. So the caveat that I'm going to note here to all of these mind twisting proofs is that the tax code is written in pencil, not pen. So while I do think all of this holds pretty steady for the way our tax code works today in 2022, it is possible that marginal tax rates could double or triple, who knows, loopholes could close, and the system itself could be overhauled, or Social Security payments could change in such a way that these arguments no longer make sense. My perspective is, let's make the best decisions with the information we have today and build in some flexibility and tax diversification to address those potential future changes. I consider the 401k your tax magic school bus. I think it's the first basket you should visit before you even think about doing anything else if you have one. And by the way, I am looking at myself in 2017 saying, Katie, put down the iPhone, step away from the Robinhood app, go increase your 401k contribution first. Here's the deal. You need to contribute at least up to your company match. That is free money on the table that will compound and is definitely considered part of your total compensation in the eyes of the company. But I would shoot for 10% or higher if at all possible. Now, if your 401k plan has crazy fees, this calculus may change slightly. The fees are not a showstopper, in my opinion, for people that are getting, say, a 6% dollar for dollar match, because the extra money that the company is kicking in, and you obviously have to contribute to get that extra money, will offset any losses you suffer from extra management fees. But it is something to be conscious of if you know that you do not get a match. In that case, you are comparing the value of your upfront tax break to the annual management fees, and after your balance gets large enough, it may not make sense. I hope that's not the case for you, and when you leave that employer with the 401k plan with high fees, you want to roll it over quickly. In any case, 10% is a healthy figure to aim for in a 401k plan. And once you've hit 10%, then go for maxing it out. I find that sometimes people really need a number to cling to, and I like 10% because it tells me that at the very least, if you're saving 10% of your income, you are going to be able to retire eventually. It might just not be as soon as you want. The other benefit of the 401k that I don't think we should ignore here is a psychological one. When I reflect back on my own 401k journey, a sentence that is so nerdy it physically pains me, I set my contribution to 10% on day one of my employment because my mom practically bullied me into it. And since I never saw the money, it never really felt like a loss. I never got a single paycheck that did not already have that 10% contribution taken out of it, so I didn't know what I was missing. As humans, we tend to feel the pain of losses more acutely than the joy of gains, and the research around loss aversion is so interesting. So it's almost always going to be better to just commit to the amount up front rather than tell yourself you're going to work your way up to it later. Once you see the money on your paycheck, it'll be very challenging psychologically to then go back and increase your contribution. Some plans do have these clever commitment devices wherein it'll automatically increase your contribution as you earn more. Go ahead and turn that on if you have it. The point is, since the 401k removes the action step on your end and just makes the transfer before you even get paid, it means we are less likely to fall victim to our human tendency to shirk the hard decision when the time comes. All right, so that concludes basket number 1. Let's move on to our second priority. Basket number 2, the Roth IRA. If you are anything like most people I talk to, you probably just said one of two things. And by the way, I also said this back when I was first learning about these things, so you're in good company. You either said, "What the hell is that?" Or you said, "But I have a 401k. What do I need an IRA for?" You need an IRA for the same reason you have a 401k. Tax-free growth, baby. The IRA is a smaller basket. It only allows you to contribute $6,000 per year as of 2022. It's going up to $6,500 per year next year in 2023, and it is higher if you have catch-up contributions after a certain age. But hey, that is still $6,000 per year that generates returns off the top of which the IRS can't skim on an annual basis. If you don't have access to a 401k, this is no-brainer next best option. So a few things to note. Number 1, you have more control over your IRA than your 401k because you get to choose the brokerage firm and the fee structure. I'll be honest, my Roth IRA is with a company called M1 Finance in the ultra aggressive pie. This is volatile. It means that I'm almost 100% invested in stocks in that Roth IRA, and riskier stocks at that. As I get older, I'll worry more about dialing back the risk in this account, but for now, I'm okay with it even in this current market, especially because this is probably the account that I'm going to use last, as we've talked about back in that episode about paying no taxes in early retirement. Number 2, while you can have either a traditional IRA or a Roth IRA, I personally prefer to leverage the Roth IRA. For one thing, the rules around deductibility are a little funky for traditional IRAs. If you're covered by a retirement plan at work, like the 401k, you can't deduct your traditional IRA contribution, which basically eliminates the most valuable component of a pre-tax investment account. And while the Roth IRA does have an income limit phase out, so in 2022, it's $144K for singles and $214K for married filing jointly, it is relatively easy to yeet around that by using a backdoor Roth IRA, but the TLDR is that you can do a non-deductible traditional IRA contribution, then convert the funds to a Roth IRA once they settle, as long as you don't have any other money in traditional rollover SEP IRAs lying around. Pretty much any IRA with pre-tax funds in it, you don't want those if you're going to be doing this. And lastly, number 3, the feds are serious about that annual limit, y'all. There aren't really any safeguards in place to stop you from going over. So make sure if you're doing this as like a monthly dollar cost averaging thing that you're putting in $500 per month. If you split your annual contributions into that monthly cadence like I do, or you'll be penalized for the amount over the limit. It feels pretty ironic to be punished for accidentally investing too much for retirement, but tax laws are unforgiving. You will be faced with a 6% penalty each year on the excess amount until you correct the mistake. All that to say, your second priority, the Roth IRA. Max it out, $500 a month. Easier said than done, but actually might be easier done than expected. If you are a super saver, you probably are not spending this money anyway. One thing I hear sometimes from high earners is, well, I pay an incredibly high marginal tax rate. I don't want to contribute to a Roth IRA at all because of that, even if I can manage it using the back door. And I want to take pains to clarify something here. Contributing to a Roth IRA does not create additional tax burden. The money that you contribute is treated no differently than money you take as income to spend or money you take as income and then contribute to a taxable brokerage account. On the front end, all three of these things look the same in the eyes of the IRS. So you're going to pay your regular income taxes on a contribution to a Roth IRA or a taxable brokerage account. The only difference is that the money you put in a Roth IRA is never taxed again. So I caution high earners from prioritizing a Roth IRA over something like a pre-tax 401k. But once you've already contributed the maximum to that 401k, your Roth IRA really is probably the next best place, with the exception maybe of the HSA, which we'll chat about in a moment. All that to say, you don't pay additional tax by contributing to a Roth IRA rather than a taxable account. Your upfront tax liability on those two decisions is the same, but your long-term gains in the Roth IRA will be much greater. Now, a popular question: should I contribute the maximum to my 401k before pivoting to my Roth IRA, or can I do both? Look, at this rate, you are already doing more than literally 90% of people, so I'm not going to draw this hard line in the sand here perspective-wise. Sure, if you want to be as optimized as possible, the technically most efficient way to move forward would be contribute as much as you possibly can to the traditional 401k and then multiply that contribution amount by your marginal tax rate to determine how much that just saved you in taxes, and then contribute that amount throughout the year to your Roth IRA. Because to reiterate, we are creating more investable income by using our 401k, and then we are investing that income into the Roth IRA. For example, if I'm a single gal and I'm earning $150K, I'm in the 24% marginal tax bracket. And if I contribute the full $20,500 to my 401k, based on a tax calculator at that bracket, I'm saving $4,920 on my taxes that I now get to keep and can turn around and contribute to a Roth IRA. Theoretically, it would be perfectly optimized to not contribute to the Roth IRA until the full tax advantage of the 401k is leveraged, but that's kind of splitting hairs. If you aren't able to contribute the maximum to both and you want to split your investable income between them, please be my guest. You are still getting amazing tax diversification, even if it is not the technically most optimal. The important thing is that these two buckets are receiving the lion's share of your investable income because, as we stated in the beginning, this is our long-term investing strategy for ending up with as much money as possible later, and we want to avoid tax drag or the compounding erosion effect that taxes have on your growth as much as we possibly can.